And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome to the show. This morning is, of course, Thursday, second best day of the week. Michael Lebowitz joins me this morning. Got a lot to talk about after the Fed meeting yesterday. QE, not QE, that's the big question. But again, we'll get into all that this morning. A couple of other kind of interesting things going on first, though. Indonesia is now cracking down on finfluencers, right? These are these guys on social media. Indonesia says that these people are salespeople. They are not financial advisors. Sound familiar? Just saying. Be careful where you get your information from. But anyway, finfluencers in Indonesia, maybe not so much. We'll see if that ever happens in the U.S. I doubt it, but there's too much money to be made in it. Anyway, outside of that, Eli Lilly this morning is going to be up fairly sharply. They just came out with a new drug that's their next-gen drug for osteoarthritis. That actually tops Novo Nordisk's Zebound. So that stock's going to be up fairly sharply this morning. Eli Lilly's had a very, very strong run over the last few years and continued to make gains. Of course, their leading drug right now is of course the semaglutides, the weight loss drugs. And that really kind of continues to be a major market that's growing right now. So we're going to, again, playing well, but again, this is kind of a good piece of news this morning for Eli Lilly. The big news, of course, last night was Oracle. Can't miss Oracle. So the markets rallied yesterday following the Fed announcement, and what the Fed giveth, Oracle taketh away, as they say. After the bell last night, Oracle announced earnings. The earnings were not bad. Okay, the earnings were not bad. If you actually dig down into the earnings, they were good. Very, very strong revenue growth, very, very strong EPS growth. So again, everything was there. Revenue was just slightly lighter than what the market was expecting, and that's going to lead to about 11% drop in Oracle this morning. That's also kind of weighing on S&P futures a bit this morning as well, particularly in the AI space, all those stocks taking a very mild hit. I mean, a lot of these stocks are down 1%, 1.5%, those type of things. So, NVIDIA's down a little bit, Microsoft's down a little bit this morning. Oracle's the one getting the biggest hit, but again, the earnings were not bad at all. But again, this is the problem when everything is priced for perfection, that even a small miss leads to a very kind of outsized move in Oracle. Now, what's interesting about Oracle is that entire move that it had following its announcement of doing a big deal on building out data centers has been completely reversed. So you got when and this is why a little bit of what we talked about yesterday. When you have these very abnormal moves in stocks, bonds, commodities, whatever it is, don't forget to take profits, because a lot of times those things get reversed. It's just a function of time and statistics. So again, this is what we spent some time yesterday talking about. Taking profits, rebalancing risk, those type of things. When you get these big outsized moves, like Google recently had a big outsized move, we took profits in that stock, reduced our position a bit. And again, when it eventually pulls back, we'll add back to it. But that's just good portfolio management, over time. As we talked about before, it's a lot like gardening. And, if you plant a garden and you grow a bunch of beautiful fruits and things in your garden and you never harvest them, they'll just die on the vine and rot. So it does, you've got to harvest your bounty every now and then in your portfolio, and it'll give your portfolio longevity, because again, that cash that you raise from, trimming positions, rebalancing risk, gives you opportunity when things do pull back. If you still like Oracle, now you've got a better entry opportunity to buy Oracle going forward. But again, that's just part of the portfolio management process. We tend to forget that part because we're all excited about everything going up and we just want more. But markets do correct. Now, let's talk about markets correcting. Interesting stat out this morning I posted on our X account at Lance Roberts, is there have been 1,000, more than 1,000, that's the right number, more than 1,000 ETFs issued this year alone. There's been just a massive surge of new ETF issuances hitting the markets over the last couple of years, but you've had 1,000 of them hit the markets this year. Most of them are leveraged or very high risk-based strategies. So, cryptocurrencies or options trading, those type of things. Lots of high risk, lots of leverage. Why? Because that's what the market wants right now. We've got a very speculative market, and it's just something worth paying attention to, because this is symptomatic of the markets. Remember back in 2020 as a good example, and 2021 in particular, when we came out of the COVID, we had all that money coming into the markets. We started issuing out SPACs and ETFs and everything else we could think of because there was demand for product. Right now, this is a money grab. So when you're seeing all these ETFs being issued, these are people sitting there going, hey, there's a lot of people wanting to buy this stuff. Let's get a product out there and grab some assets so we can make money, right? So this is a function of getting money for them to manage. They'll charge a fee for that, of course. That's how they make money. But there's this land grab right now for money because there's so much money wanting to come into the markets. People are just issuing ETFs like crazy. Most of these will not survive. And so two things to understand about this. One, this is a sign of a very speculative market. And over the next 5 years, you should start to expect much lower rates of return out of markets because of the speculative excess in the markets. It will eventually reverse. Doesn't mean tomorrow, next week, next month, but over the next 5 years, expect lower returns. Secondly, most of these will not survive, so make sure that if you are buying ETFs, make sure that you are buying an ETF that has survivability, because the loss ratio in a lot of these ETFs are going to be pretty dramatic when you eventually get this cycle. So over the next few years, again, this isn't something you go panic and do anything about today, but it's something to pay attention to. Over the next 5 years, we are likely to see a contraction in the ETF market as a lot of these start to go away when markets decline, etc. Anyway, that's all kind of the news this morning. News you can use right here on the Real Investment Show. All right, let's talk a little bit about the markets. Yesterday, like I said, markets had a nice little bounce right after the Fed announcement. We'll talk a little bit more about the Fed announcement this morning with Michael Lebowitz. But again, we are sitting right at all-time highs. I mean, we are just a smidge below all-time highs here in the markets as of yesterday's close. Again, buy signal in place, relative strength a little bit overbought here. It's kind of, the momentum still in a good spot. Again, markets are going to be a little bit weaker this morning. We're looking at the S&P to open down about, 10 points or so. Dow's going to be down about 26 points. The Nasdaq's going to hit the hardest because of Oracle. But all these indexes are within 2% of all-time highs. Now, the interesting news about this is that when the Fed cuts with the market within 2% of all-time highs, the volatility in the market over the next month or so tends to be a little bit higher. In other words, we tend to see a little bit of a correction in the markets, etc. Over the next 3 months, volatility tends to be a little bit higher. Over the course of the next 12 months, markets tend to be higher, period. So again, over the next month or so, when the Fed's cutting very close to all-time highs, typically leads to a little bit of corrective action in the markets. Not always, but about 50% of the time, you're like the next month might be a little bit lower than this month, that type of thing. Again, nothing dramatic. We just went through some corrections back in November. Of course, we had this correction back in late October, November. Everybody's losing their minds, like the whole market's going to die. We had a 5% correction. Expect that. Expect that type of action maybe over the next month or so, some type of pullback, maybe January, February, and then the market will get its feet under it. But again, a lot of this will depend on what the Fed's doing, of course. Are they going to keep cutting rates? That's going to be the debate we'll have this morning with Michael Lebowitz. Also, what is this new QE, not QE thing that we're doing, buying $40 billion worth of bonds? What does that mean for markets? More liquidity should be supportive. But again, as we discussed yesterday, in terms of the markets right now, we're still within this consolidation range. I would still expect a little bit of a pullback here towards the 50-day moving average between now and maybe Christmas. To set the market up for a bit of a rally into year end. It looks like we're going to finish up the year about where we are, maybe not too much higher, maybe a little bit lower. But again, we're going to be kind of probably fairly close to where we are. That's about a 17% gain for the year, not including dividends. So throw your dividends about 1.8%. So you're going to be close to 19%. Probably by the end of the year, unless we just happen to get a spurt higher or some bit of sell-off here. But again, we'll probably wind up fairly close to where we are, and this is going to kind of set the market up for next year. And again, like I said, I've got an article coming out in the next 2 weeks, right before Christmas, talking about valuation ranges and kind of a price target range for next year where the market could trade based on, if you have a recession, no recession, soft landing, economic growth, kind of what that market spread looks like. So that'll be coming out, just kind of give you some idea, kind of the look forward for next year. And then also we'll have our investor resolution list that we put out every year. That'll be coming out. That's the one you print out, throw on your desk for the year to keep you on track. So anyway, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. We'll talk all about Fed, QE, not QE. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Lebowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning, of course. Michael Lebowitz joining me this morning. Michael.
Yes.
How you doing, sir?
I'm doing great.
We need to add Ulta to our portfolio because Ulta, the beauty store chain.
Okay.
ULTA is their symbol. The reason is I thought I would be very nice yesterday. I went home from work yesterday, and my wife was at home, and of course she's been going through a lot lately. And she mentioned to me that she needed a refill for some of her face stuff, whatever women do, these beauty regimens that women have. And so I said, honey, grab your stuff. I said, I'm hungry. Let's go grab something to eat, and I'll take you wherever you want to go, and you can go get your stuff, wherever it is, right? She goes, I just need to run to Ulta, and we can go eat at this little restaurant that's right next to Ulta. And I'm like, okay, fine, no problem. And so we go eat, and then we go into Ulta, and there was one of the salespeople there, and I grabbed the sales lady, and I said, look, it's my wife's birthday. She just had her birthday. She's been going through a lot lately. I said, go take her and take care of her. Just, it doesn't matter. Just go whatever she needs. Just make sure she has what she needs. And so they did. So my wife went off, and she's happy as a lark, and it's great. Brent's already smiling. I might need a buy now, pay later plan for the tab on this little adventure that I had yesterday. So I had no idea. I guess I'm just out because I just don't do that type of stuff, right? Right? I'm very low maintenance. I mean, I'm still using Old Spice. I mean, So if there's inflation, that's where it is. I'm just telling you, forget all this healthcare stuff, right? It's all in makeup. That's where it is.
Did you get out of there in 3 digits?
Close.
Barely.
Close. So
wow.
I think we need to reconsider owning Ulta in our portfolio. Anyway.
You're not retiring soon.
I am not retiring soon. I have a bill to pay, but you know what? It's worth it. My wife's very happy. It made her day yesterday. So,
and she's gorgeous. I mean, you start with good content anyway.
Yeah,
right.
Well, she takes very good care of herself, right?
Yeah.
I mean, she is no slouch, so she does take care of herself, but it costs money.
She's a looker.
She's a looker. Well, that's why she has her own job and her own money. So now, when she always tells me, she's like, I'm out of money. I'm like, I know where it goes now.
Yeah,
so I was like, well, I'm not giving you any. Anyway, all right, Mike, let's get to work. Yesterday, the Fed announced the rate cut as expected, 25 basis points. Wasn't really anything, I don't think, I kind of read through the comments. There wasn't any in the written script, right? The written release. There wasn't a lot of major changes to that, but other than the one part about potentially, I guess, buying more bonds. And of course, there's the big debate right now: is it QE? Is it not QE? But kind of, what was your takeaway yesterday? Anything surprising?
Yeah, actually, there was. And like you mentioned, they made almost no changes to the statement. That was a surprise. So the market was going into this expecting what they're calling a hawkish cut. They were going to cut rates and then start talking a little more hawkishly, and possibly raising the possibility that they may raise rates in the future because inflation is still stuck around 3%. The fact that the statement was basically unchanged except for the QE, and we'll unpack QE in a little bit because I think there was a lot, tells me that the Fed's stance is pretty much where it was 6 weeks ago, which no one considered a hawkish cut. Then you get to Chairman Powell's speech, and he was more dovish than he was at the last meeting 6 weeks ago. So for starters, he said the unemployment, the rate of growth, which based on the Fed or based on, I'm sorry, the BLS, we think is growing about we think because we haven't had numbers in ages, but we think is about 40,000 a month. He said it's really minus 20,000 a month. He said we know that these things get adjusted, so that's the way we think about it. So the Fed thinks that there's job shrinkage right now, and ADP certainly confirms that. And he said they use private data. The other interesting thing he said is that inflation, without the excess inflation due to tariffs, is 2%, right around 2%. So he's blaming the difference between 3 and 2% on tariffs. But unlike he has always talked about tariffs and the risk that they become persistent inflation, the word persistent didn't come up yesterday. So he kind of paraphrased it as the old transitory word, which is probably not a word he wants to use again, but that we're going to get a bump in prices. And he said this, certain goods are going up in price. But once they go up in price, we've talked about this before, they're not going up again. The tariff is a one-time hit. And I think he used the words one-time hit. So in the chairman's mind, he thinks we're losing 20,000 jobs a month and that inflation is 2%, except for tariffs, whose effect will be going away very shortly, over the next few months. The other thing is that there were 3 dissents. One voted to cut rates by 50, 2 voted to abstain. And this was my article last week where we talk about how there's going to be more dissents and you're going to hear very differing views from the different Fed members. As we get into next year, we have 2 new Fed voting members, which are hawkish. So what's 3 today could be 5 when those 2 members join. So I think that unto itself was on the margin more dovish, not less dovish or hawkish or however anyone else wants to paraphrase it.
Right. And actually there was I just posted a chart this morning. I copied you on it on Twitter. I'll bring this up here real quick. It's the Augur FOMC statement analysis. And they look at each one of kind of the statements and then they kind of rank it whether it's more hawkish or more dovish. And according to Augur, this was the most dovish kind of dovish statement from the Fed since 2021. So they've been consistently getting a bit more dovish as of late. But I just thought that was to your point, I thought that was a bit interesting this morning.
Yeah, that's interesting. And I think what the market hasn't really digested yet was, again, they were expecting a hawkish cut and you got a more dovish cut. That's a big difference. And we haven't even talked about QE. That's just looking at what we saw from the statement, the press conference. Actually, Lance, it was the quarterly economic forecast as well. They said that growth is going to be decently stronger, but they lowered their inflation forecast by 0.1% from where they had it in September. So again, that's on the margin a little more dovish. There's a weird range of where the Fed members think Fed funds will be next year. It ranges everywhere from 3.9% to 2.1%. again, and that's that varying opinions that we're starting to see at the Fed and no longer the group think. So I think we're going to get more divergent, possibly confusing messages from the Fed going forward. And then obviously Hassett or whoever President Trump will put into that seat in May will certainly shake things up even more so.
Yeah, and right now it looks like, the kind of the betting odds right now are that it's going to be Kevin Hassett at the moment. I mean, it's pretty strong odds that it'll be Kevin Hassett that takes that seat over as Fed chair. And again, I guess how the market interprets that is going to be kind of the question, right? Everybody, remember, it's interesting because I remember when Jerome Powell was first picked to be, the Fed chairman. And this was coming after, we had Janet Yellen and we had Ben Bernanke before that. And, Yellen was a disaster. But when Yellen was coming out, everybody was like, oh, this is going to be great because Jerome Powell is so different than every other Fed president. He's very academic. He's very, he's got experience. He really knows what he's doing. He's going to be very different. And it really wasn't different at all. So, every time we get one of these new Fed presidents, we always expect them to be different. This time it's going to be different because of their background or whatever it is, but then they tend to just start working in the same manner as every other Fed president before them.
Right. And look, the market's not going to wait till May to price in Hassett. If they think there's an 80% chance that Hassett's going to be the next Fed chair, they're going to start pricing that in today. And if his odds fade, they'll price it back out and price in whatever someone else, whoever they think will replace him, will be. So the market's not going to wait till May and say, oh, wow, it really was Hassett. Let's completely change direction. Let's boost up yields or drop yields, or stocks should go up or down because of this. The market will slowly price it in to the point when he's announced, in theory, it may not have any impact on the market because the market had already priced it in. So Lance, that leaves us with the that one big thing in the Fed statement yesterday.
The QE, not QE.
QE,
that is
not
the question.
QE.
That is the question.
And it was so funny. I was kind of watching a press conference and I had Twitter up. So you get all the snarky comments. And I follow a lot of economists, a lot of Wall Street guys, a lot of the media guys that really follow the Fed. And not all of them, but some of them were so quick to call it not QE. Guy from the Financial Times says, don't mistake this with QE. And, right off the bat. And look, the Fed calls it reserve management purchases. So obviously it's not QE, it's RMP. This is how it works. The Fed, starting, I think, December 10th, will be buying $40 billion a month of short-term Treasury bills or possibly notes. They will be adding to their balance sheet. The balance sheet will be growing by $40 billion a month for a few months. The impact is that they will add reserves to the banking system. That's QE. I don't care whether they're buying a one-day bond, a bond that matures this Friday, or a bond that matures 400 years from now, 30 years from now, whatever it is. It's QE. Because here's what happens. They'll buy, let's just say they buy a 1 week bill. You say it's not really QE. It's there for a week and then it matures and it goes away. That's not really the way it works. They buy the bond they buy the 1 week bond. It's there for a week. Next Thursday, it matures. The Fed doesn't let their balance sheet drop. They try to maintain a balance sheet at a certain level. Right now it's going to be growing 40 a month. So when a bond matures, they have to buy another bond. So maybe they'll buy a series of 1 week bonds for the next 30 years. That's the same as buying a 30-year bond. They're not doing QT and letting bonds mature.
Right.
And what's interesting is this could, now we're starting to get conspiracy theory, but this could be a little bit of a cover up where they say they're going to buy bills and they buy bills, right? So they're 3 months, they buy 120 billion bills. Those bills all mature by, the end of next year. And as they mature, they're buying 5, 10, 30-year paper, right? So effectively, this is QE as most people think it is, where they're buying longer term paper.
Well, we've had variations of
QE, not QE before, right? So it is what it is, and it's easy to debate why this, kind of the media's perspective is, and those saying this isn't QE, is technically they're correct. The Fed didn't come out and say, as they did say in 2020, at the pandemic, hey, we're going to be doing $120 billion a month, expanding our balance sheet, those type of things. That was clearly QE. This isn't QE because it's not an overt increase of the balance sheet. It may still increase the balance sheet, but the goal is to, as is to kind of maintain the stability of the balance sheet and make sure there's liquidity in the markets. But yes, it's at the end of the day, if you're buying bonds, putting them on your balance sheet, taking those off the hands of the banks, it's QE.
And putting reserves in the banking system that can be lent.
Exactly. So it is QE, but again, there's going to be a lot of debate over this, and I'm not sure. The debate's fine. I'm not sure it really matters at the end of the day. The real question is it putting liquidity into the banks? Is that going to support the financial markets? The answers to that are yes.
Well, and what's interesting, I was thinking about this. 2019, the Fed cut rates 3 times. The Fed has just cut for the 3rd time, right?
Mm-hmm, right.
And the Fed did this not QE in 2019.
Right.
It's a little different. Yeah. So, which pandemic is coming down the pike in February?
Well, it's not necessarily a pandemic. It could be, kind of a variety of anything, right? I mean, you just need some type of, exogenous risk that hits the markets that all of a sudden, causes these very high valuations to become problematic. This is kind of the big thing right now is everybody's focused on these valuation levels. Like, oh, we've got these very high valuations levels. Yes, we do. And valuations are a function of sentiment. Right now, everybody's willing to chase leverage. I was talking about with the ETFs, right? I mean, you can just issue an ETF right now and people throw money at it. So yeah, valuations are high because sentiment's high. But the problem becomes with high valuations is that if anything that comes along that adjusts the expectations for earnings going forward, now you got a problem. And what causes that? Who knows? It could be a variety of anything, but I think that's the big risk, kind of going into next year, is you do have this valuation issue that potentially becomes problematic if earnings for any reason, and again, earnings are very high. Earnings expectations for next year are expected to grow double digits again, right? And you've had very strong earnings growth, but most of that earnings growth, almost 50% of that earnings growth has come from 10 companies. So without those 10 companies, you didn't really grow earnings that much in the overall market. So if anything happens that all of a sudden Apple, Microsoft, Google, Berkshire, et cetera, aren't growing earnings, that's going to be more problematic for the market than probably just about anything else.
And correct me if I'm wrong, but don't they think that earnings will come from the other 490 companies this year?
Yeah, they're expecting
better breadth.
They're expecting a 60% increase in small cap stocks this year. So, there's a lot of hope built into the markets going into next year. And look, and don't take me and Mike wrong, right? We're not saying that the markets are going to crash next year at all. All we're saying is that there is a very high level of expectation going on for next year that leaves the market more fragile to disappointment. So, if the markets aren't grossly overvalued and something goes wrong, you don't have big corrections. But when markets are very overvalued and you have a lot of sentiment and a lot of speculation, it makes the market more sensitive to even minor changes in outlooks. I mean, the good example is just look at Oracle, right? I mean, Oracle's down, the earnings were great yesterday. They barely missed on revenue and the stock's down 12% today. That's the break between, what people were expecting and what actually happened, and that repricing is occurring very rapidly. That's the risk we take next year because of where the markets are.
All right, and conversely, if valuations were very low, we wouldn't even care. If they were low enough, PEs have been in the high single digits. Mm-hmm. If we had a PE of 8 for the market, I'm not sure I would even care if we were going into a recession, right? Because you're getting them so cheap. We're at the opposite end of that spectrum where it doesn't mean the market can't keep rallying and valuations can't keep more. But what it does mean is you have to be on your toes and you have to expect that the market could correct, that valuations will eventually correct.
So
whether that's this year or next year,
who knows?
we don't know.
But again, that's the challenge of investing, and that's why we talk a lot about risk management and those type of things, because it's the time. It's easy to go, hey, the markets are going to crash. Great. When are they going to crash, right? Because if you go to cash today and market doesn't crash for 3 years, you miss out on a lot of returns. But that's also one of the other sides of this going into next year. We've had 3 years now of near 20% returns. And when you have periods, and I touched on this in last weekend's newsletter, but when you have periods like this where you have very strong returns over a 3-year period, markets tend to revert to the mean in terms of returns. In other words, you get lower returns in the subsequent years, almost like clockwork. There's an old saying called, the reversion to the mean is the most powerful force in investing. And that's kind of where we are now. We have very elevated rates of return in the markets for the last 3 years in a row. So again, you should kind of start expecting that you're going to get a reversion back towards the mean average return of markets over time, which is, that 8 to 10% everybody always talks about. You should start to kind of expecting a reversion of those returns. Again, that doesn't mean the markets are going to crash at all. It just suggests that maybe returns going forward could be very disappointing in terms of 8, 9, 10% returns on a year rather than 17, 18, 19, 20. And all of a sudden you're going, man, this market sucks. I'm not making any money. But you should kind of expect that.
But Lance, I could also make the argument that the market falls 10, 15%, but there's 300 stocks that are up next year.
Yeah.
That the market rotates from the NVIDIAs, from the Magnificent Seven, to those other stocks that have been lagging for such a long time. So, it doesn't, just because the market's up or down, doesn't always tell you what the market as a whole is doing. Because the Magnificent 7 or 10 or whatever it is 40% of the S&P. I mean, that's a big deal. So you have all these other stocks that have almost zero contribution. Even in 2000, when a good number of stocks were down, small cap value did extremely well. Value did well. So there's usually a place you can rotate into. So again, whether the market's up or down next year, the goal is to manage that risk, but also to rotate into and out of the sectors, the factors, the type of stocks that are working or not working.
Yeah, that's something I kind of touched on today in our daily market commentary. So if you haven't read our daily market commentary yet, if you're subscribed, it'll be hitting your email box in about 45 minutes. It goes out at 7:30. But that was something, Mike, I touched on today is looking at the kind of the break between value and growth. And, growth has outperformed value by such a large stretch, particularly over the last couple of years, that you almost kind of expect at some point some type of reversion in that value growth trade. And if you start digging down into kind of the S&P, you start looking at staples and utilities and real estate, there's some really good value there with high dividends. I mean, you can buy some of these stocks and pick up, 3-4% dividend yields where you're waiting eventually for price performance to improve. There just seems to be a lot more opportunities starting to show up, to your point, in that and kind of that more defensive risk off sector. So to your point, you could see a correction in the technology, healthcare, finance stocks and see a big rotation into the more value oriented stuff.
Right. Energy and financials as well.
Yeah.
There's some mouth-watering stocks, and when you look at them, they're the most boring graphs you would never know we've been in a bull market for years.
Right.
They've just gone nowhere. But that doesn't, just because their value doesn't mean that they will be back in vogue. Over the last 100 years, investors have always been paid to buy value over growth, but there have been periods where growth outperforms value. And we are in a very extended period of growth outperforming value. And, I think a lot of new investors, last 10, 15 years, why would you ever buy value? Growth is the only place to be at. And, you go back 100 years, and if you look at some of those graphs, you're like, this isn't looking good for growth. They've had an extended run. Value is going to take its place back on the throne again. So, when you're looking at these kinds of things, it's important to understand what's gone on recently, but also understand the longer term. Like when we look at graphs, we kind of start with the 1-day graph and kind of what it's been telling us over the last 3 to 6 months, or even shorter than that. But we always kind of pull back out to the weekly, to the monthly, to get you that full perspective on what something's doing. And, that's the way you should look at valuations in addition to doing technical analysis.
Well, and again, this is, of course, I've said this before on the show. We've been talking about, this return to value for the last few years, and it hasn't happened yet. And I made the comment recently that, when I die, my tombstone will say, "Hey, value's going to come back someday." But it hasn't happened yet because there's been such this chase for growth. As I was talking about this morning here, I'll just show you the stats. I was talking about this in the open this morning, talking about the number of ETFs that are being issued. And the ramp up in ETFs being issued, again, is just kind of symptomatic of where we are in this market. And you've just seen, particularly since 2021, this very rapid increase in the number of ETFs being issued. And the vast majority of these ETFs are in leveraged equity. Brent can bring this chart up for me. Leveraged equity, option strategy, cryptocurrency. That's been a big chunk of and this is just in the month of November. This is what was launched in November, so not all year, but just in the month of November, you had almost 60 ETFs launched just in the last month, that were all very high risk, high beta type trades. And that's not surprising. But again, on that list, no value, right? So, value's been, to your point, Mike, value's been out of vogue. Nobody wants it. Maybe that's the time that you start looking at, hey, maybe I add a little bit of value to my portfolio. You don't shift your whole portfolio from growth to value, because right now growth is still intact. But maybe this is where you start kind of, fishing around the edges, adding a little bit of value, adding a little bit of defense, because when the market does rotate, it'll act as a hedge for your portfolio because money will gravitate towards value out of growth. But it could be kind of, if we do get a reversion of that cycle where value does eventually start to outperform growth, that could serve you very well. And again, I posted one more chart out this morning. I'm going to do some more analysis on this, but I've done this before. Took the KPE, which is the cyclically adjusted PE ratio by Shiller, which uses 10-year trailing returns, and I've cut that down to 5 because it's more market sensitive. So I call it it's the Cape 5 ratio. But that Cape 5 ratio is more sensitive to market dynamics, which is extremely overvalued right now. But this is just showing you what the expected rate of return for the next 5 years based on current, and this is forward PEs, by the way. So this is even the most optimistic outlook for earnings. You're looking at very potentially low rates of return. Again, that doesn't mean low rates of return every year at all. It means that probably somewhere within the next 5 years, you're going to get a 20 or 30% down market somewhere. And then markets are going to rally back and you're going to have a zero rate of return over 5 years. But in that type of environment, if that would turn out to be the case, and Mike and I are not saying, I want to be really clear, Mike and I are not saying the markets are about to crash. We're not saying that at all. We're not saying go get into cash right now. What we're saying is that if the historical trends of 5-year valuations are accurate, that having some value and defense in your portfolio over the next 5 years could be very beneficial to helping you survive what the market provides. And again, that's the whole trick to this. It's great to enjoy all this speculative chase in the markets, which has been great this year. It was great last year, great the year before. Buy leverage, buy risk. That's been a fantastic trade. By the way, the BIS just came out with a very interesting report. It'll be in this weekend's newsletter. We're covering it. The BIS, which is the Bank for International Settlements, just came out with a report about what happens in markets when gold and stocks go up at the same time. So, this is the type of market. We've had a lot of risk, a lot of speculation. If you get a reversal of that, you're going to want some defense in your portfolio. Mike?
Yeah, and I would say, now is the time to start getting your AAA roster going. Find 5, 10, 15 value stocks that you like. You don't have to buy them. You don't have to, add a little bit, but just have some names ready to go so that when things do change in a market, you're ready. You're not caught, off foot. and can react pretty quickly. But yeah, Lance, to your point, valuations are high, and at some point they will correct. The question is how. Will it be a broad market correction, or will it be a sector rotation where technology corrects significantly, where communications correct, but some of these other sectors that have just been in the dumps start doing well, start certainly beating the market and possibly even giving you gains if the market is off a decent amount. So now's the time to prepare, not in the future.
Yeah, well, and also too, I mean, again, like I said earlier, you can buy a lot of these stocks and pick up 3-4% dividend yields on a lot of these companies and get paid while you wait too. So I mean, and this is kind of the interesting thing is that, you know, when you add bonds to a portfolio and you know, or defensive dividend yielding stocks, those type of things, yes, it's going to impair your returns because they're not going to go up 15% a year. But they're a defensive risk-off rotation, so if something happens in the markets, that's where money's going to gravitate to for defense. But you're still cranking out 4 and 5% rates of return over time. And again, that sounds low when you're in a market where you've gotten 17, 18, 19% over the last 3 years. But historically speaking, if markets return on average 8 to 10%, you know, you've got very defensive positions just providing an income stream into your portfolio that's half that average rate. So you don't need a lot. We talked about this a bit yesterday. You don't need a lot of market growth to meet your financial goals. And again, this is what's important is when we're managing our money, what's our goal? Is our goal to try to generate 20% returns every year, get rich quick? Or is our goal to survive the long game and make sure our portfolio is intact when we get to retirement? So again, it's just, you know, trying to temper expectations a bit and start thinking about what's really the goal for your portfolio and then managing that portfolio for risk and volatility and, you know, managing growth and return over time.
And I would just add, Lance, currently we have high growth, certainly have high growth in our portfolio, but we also have value stocks in our portfolio today because we run diversified portfolios, right? We have Procter & Gamble, Berkshire Hathaway. In the sector model, we have utilities, we have staples, we have finance, we have some of those beaten down value sectors. So, you know, it's always important to be diversified, stay diversified, and change between growth and value and between all these other factors that can have such an impact on returns. And always think about, I think this is the thing we want to impart upon clients the most. Look at the bottom line. Not all the little puzzle pieces on how you get to those returns, but what's the bottom line? And how does that compare to what you need to meet your goals, to meet your retirement goals? That's what's important. And that's where value stocks, even in this environment, can add value, so to speak.
Absolutely. Today coming up, we've got Broadcom reporting today, so another AI stock that'll, you know, potentially kind of weigh on the market in the next day or so. We'll see what they report today. Costco, Lululemon, which is interesting to watch. I like to watch Lululemon because that is a purely discretionary item. I don't need to buy workout gear from Lululemon, right? So, or golf shirts or whatever. So that's a really good, you know, kind of proxy. We've been watching a lot of these retail stocks over the course of the last, you know, month or so, talking about, you know, Walmart and Costco and Target and all these, you know, talking about the consumer traffic, consumer trends, those type of things. We're clearly seeing some weakness in the consumer, and we're starting to see even higher net worth consumers step down in terms of where they're shopping. So Lululemon is a very high dollar store, right? So it'll be interesting to see what they say about their sales growth and what's happening and as compared to what we saw from Walmart, which said, hey, we're seeing a lot of high-end traffic shoppers coming in and buying clothes and groceries and everything else at Walmart, stepping down from the higher end retailers. So it'll be one to watch. Restoration Hardware is also another good one. That's a very expensive kind of furniture company. So they also will tell you a lot about what's going on with the consumer. And again, as we start moving into next year, the big question for the Fed, whether they're going to cut rates more or not, comes down to the consumer, because consumer consumption drives employment, it drives economic growth, it drives earnings, it drives revenue. Everything comes, we're a consumer-based economy. 70% of the economy is driven by consumption, so everything's based on the consumer. So if we're starting to see real cracks within the consumer, and again, we're not talking about the consumer just completely falling apart, but we are seeing rising delinquency rates in student loans and auto loans and those type of things. We're not seeing it yet in mortgages, not really seeing it yet in longer term debt structures, but we are starting to see a pickup in delinquencies and late pays on credit cards, as an example, starting to see consumers step down. That's going to give you a little bit better outlook about what economic growth is going to be like next year. And if economic growth is slower, earnings are going to be slower. That's going to potentially weigh on market returns and have to keep the Fed more on track of cutting rates than not. So it'll be something worth kind of watching these earnings reports today when they come out. Mike, any closing thoughts?
It's QE. We're standing firm.
It's QE. You can call it whatever you want, but it's QE.
The media is going to be all over the public trying to convince them it's not QE. It's QE.
It's the same thing with Beyond Meat, right? They try to convince you it's an actual
it's
burger.
Not meat.
It's not meat, okay? Just live with it. All right. Thanks a lot, Mike. Appreciate it very much. That wraps up for the show for the day. Be sure and get by the website. I can't stress enough. Get your ticket for the Economic Summit that's coming up January 17th. Ticket sales are going pretty quickly, as I've been saying. There is limited seating. We do have an event the night before, so you can mix and mingle with all the speakers. It'll be a really great event. Michael Lebowitz will be there, talking all about fixed income, interest rate outlooks, everything for next year as well. So, again, come on down, meet us. That'd be a great time. We'll talk about whatever you want to talk about. We've got plenty of time to sit around, just visit and talk as well. So, anyway, a lot of fun. January 17th. Tickets on sale now at the website, realinvestmentadvice.com. While you're there, make sure and subscribe to the weekend newsletter, the daily market commentary, the blogs, and most importantly, like and subscribe to this channel. We need likes. Please like the show today. We really appreciate it very much. It does help us a lot. All right, have a great day. See y'all back here tomorrow for Financial Fitness Friday. Have a great weekend.